Good afternoon, everybody. Some of you, we saw you not that long ago. This is the afternoon special edition of Investing Bros, where we're going to be covering the newest FOMC meetings data. We're going to cover the interest rate points coming in about 9 minutes from right now. But then we'll stick around and we'll kind of speculate based off of what we see in the press conference from Jerome Powell, what this will actually look like. Right now, we're still very, very much so expecting 25 basis points, but make sure you go vote in that poll I put up there just a little bit ago. Do you think we're going to get 25 basis points and dump maybe somewhere around 25,000? Do you think it's 25 basis points in a pump put closer towards 30,000? Or do we see something crazy happen? And despite the predictions of 25 basis points, do we see Jerome Powell come out with a pause? And do we see Bitcoin just take off closer towards 40? Make sure to go vote in that poll. I want to hear what you guys think. I am joined by my two very, very amazing co-hosts this afternoon. The first one sitting across from me, working very diligently, T-Shroom. T-Shroom, how are you doing this afternoon?
I am thoroughly exhausted, Tim.
Yeah. So not better than you deserve this day.
No, I'm still better than I deserve.
Oh, okay.
Objectively. But yeah, very exhausted. Been doing a lot of work, but I'm extremely excited to see which way our economy is going to go here.
Yeah, at some point we're going to have to decide, we're going to have to figure out what exactly you do deserve to know when you're doing better or worse than it. We're also joined by Army Piper this afternoon. How are you doing today, Army Piper?
Brother, I am just watching the charts, waiting for this data to come in, and running the show from behind the scenes over here. So I'm doing overall fantastic.
Very good stuff. Well, we got like 50 people watching right now. Go ahead and smash that like button. Thank you to everyone who chose to join in with us this afternoon. This is going to be fun because this is what we're going to do from now on, especially now that some gigs behind the scenes have rearranged themselves. I'm so excited to be back doing these FOMC meeting live. And we're going to be doing some other meetings when they come up live as well. So very excited for all of that. Let's kind of get into this and start to talk. Let's show my screen real quick. I want to kind of show you guys what's happening right now on the 5-minute chart. Did I not share my screen? There's a problem. When I don't share my screen, you guys see nothing but blackness. But when I share my screen, you guys see that. Look at that. Beautiful. That's so beautiful. Bitcoin right now, I'm going to kind of show you a screen of just Bitcoin, but I wanted to start. You guys are going to see this when we go live. I believe you're going to see this over on Piper's screen, though. We're full time looking at Bitcoin. Bitcoin down here in the left. I actually have two the exact same. This one is supposed to be, what did I have that one? S&P and then Dixie. Let me go back over to the Dixie real quick. So you guys are going to see us looking at the Dixie, Bitcoin, and the SPY, or what we call the S&P 500. I have Ethereum up here, but you guys are going to see Jerome Powell up in this box. Very interesting stuff happening right now. The Dixie just kind of hovering right there below, rejecting on the 5-minute dynamic reactor. Bitcoin, on the other hand, though, despite the fact that we had a nice little pump there, it's sitting here finding support on the 5-minute dynamic reactor, same as the SPY. So this is very, very interesting. Let's go back to single screen and take a look at what Bitcoin is doing on an individual basis. Let's go to the 4-hour chart, because you're going to notice I have that little line of resistance of our ascending triangle. I actually want to go down to the hourly chart, get a better look at this. So remember this morning, those of you who watched our morning show, and if you did not, make sure every single morning come tune in with us, 9 to 10 a.m. Eastern Standard Time. We discussed this ascending triangle formation that Bitcoin was in. Well, it turns out we ended up breaking bullish out of it. It actually happened almost immediately after we finished going live, right there at 10 o'clock this morning. We pumped up all the way to about 28,800, and now we're coming back down, retesting this level of resistance, turning it back into support. I want to make sure you guys know this, though. This was kind of what we predicted. Pre-FOMC volatility is very normal. I believe Army Piper this morning, correct me if I'm wrong, Army Piper, you said that before FOMC meetings, we can see all the way, before and after, we can see about 5% of volatility. Is that correct? I know you got to go to your screen.
No, it's correct. I can just click the unmute button. Yeah, it's about 3 to 5% of that we get during the period of time from opening to the speech. So
nice.
Yeah.
Very nice. Well, there's a couple of things I want to kind of point out to you. Notice that we also, I got to adjust my smart money concepts here. I want to come down here and show you guys not just my predictive ranges. I want to look at some support and resistance levels that we have here. We bounced almost just perfectly off of this 12-hour resistance level. It was number 3, so not the strongest one in the world, but it was one we told you guys to keep an eye on, that 28,800. Sure enough, it has been hit. Going out to the daily chart, you're also going to know this isn't just Chart Prime that's been calling for that level. That's also one, if you looked at fixed range volume profile, we talked about that actually back the last time we retested 25,200 back here in February. We discussed if we actually broke through, watch for a price around 28.8. That's because not only is it up here towards the next peak after this gap in volume, it was a major level of support back in May of 2022 before eventually we had the big dropout from the Celsius debacle. So sitting at a nice little level of resistance, I do think that the bulls are going to need some momentum to push up. And that's what we're about to get more information about. Not only what the numbers are, but then in a half hour after that, so about 23 minutes or 33 minutes from now, we're going to get to actually hear Jerome Powell speak. And I want to kind of, now we kind of examine the chart for a minute, we can go back out and just have a discussion here. Go back to the bro cam, all three of us. I want to hear from you guys. I want the audience to chime in chat as well. What are you guys fully expecting to hear in just a couple of minutes from the numbers? And then what are you expecting to hear in about a half hour from Jerome Powell? I want to start with you, T. Shroom. Lay out your expectations for this meeting.
Wow. Well, I mean, we'll get the information. We'll get the drop. There'll be a lot of chatter, a lot of clamoring on Twitter. I'm very much looking forward to that, hearing from folks like Caleb Franson, Zero Hedge, seeing a couple other influencers kind of throw their hat in the circle to try to bring a little clarity to what the decision might mean. Mm-hmm. And then we'll break down, kind of what the decision means. 25 is what I'm expecting. Yep. I think anything other than that would be pretty shocking and would bring quite a bit of volatility, but it is possible. It's definitely, I don't know what the CME futures are showing right now, but I'd give it probably a 10 to 20% chance that we could do a zero hike and just keep it flat. So I think there's a good chance, but right. I think 25 is taking the cake in my mind. And I think what I'm really looking forward to the most, like I said this in this morning stream on Investing Bros, was, what is the asset balance sheet going to look like going into the future? Are they going to go ahead and keep printing and buying up mortgage-backed securities and mostly treasuries to try to stabilize the economy? Or are they going to let it burn and see how far down, how many banks essentially are gonna crumble? Mm-hmm. And there's an argument for both ways, obviously, but I think that's kind of the pinch question, because once they answer the question today here at 2:00, which by the way is 2 minutes here, once they answer the question here in 2:00 when we get that decision drop, the next question is, okay, well, what about the balance sheet? How are you going to use that other tool that you got? Are you going to go ahead and fire up that money printer even more than you already have, which already has been a lot, and go ahead and print ourselves through this storm? Or are you going to let it burn and let these banks fall? A lot of people after the bank bailout of 2010, it would have been late 2009 after that bailout. A lot of people say let the banks fail. Let it burn, and resorting to more of a libertarian stance on macroeconomics.
There we go. Yeah, while you're talking, T-shirt, and Bitcoin just jumped back up above 28,600.
I know.
We are less than a minute away. Really quick, with the last 30 seconds, Piper, I want to get your take. What's your expectation about what we're about to see?
I think despite the high percentage, there is a possibility we could get that 0%, just because of what I was saying earlier about the valuation of the rate hike being making the treasury bonds just too expensive or too valuable for people that want to get out of banks. So it could go either way, but I still think there's a really good possibility for zero. We are about 30 seconds away from this data coming in, guys.
I mean, it's 2:00 right now. So as we're hitting refresh the screens, we should be getting those numbers in.
Yep, we got it right now. Just came in. Let me clear this out here. We came in 25 basis point hike. 25 basis point hike. So there you go.
Makes
Yeah,
sense.
we absolutely did. Let's go back over to my screen here. Let's watch. Bitcoin is screaming right now, shooting up just past 28,800. It shot back down, but it looked like at first.
Look at that Dixie. Look at that Dixie drop.
28.9. Dixie is dropping like a rock. We got the SPY climbing over here on the 5-minute chart. I'm having to minimize my screens because of the volatility of these candles. Bitcoin back below 28.7. I feel like I'm calling a race at this point. And Bitcoin in the left corner is going to climb. It's coming in 28.7. Dixie's falling. Oh, it's going down. 102, 102, 102. It's coming down. And the SPY is pulling on the head in the bottom right corner over here. It's absolutely crazy on those 5-minute candles. But this is that volatility that we talked about. So while we're doing, let's take a pause here. Go back to the bro cam. Let's read some names. We never read names, and it's because this isn't a normal stream, but I don't want to take any chances. We know in the past from morning shows that when we skip names, bad things happen. So True. I want to first start off by shouting out the first comment of this afternoon show. It's covered by my poll, but I remember it was Eric Wallen. So big shout out to Eric Wallen coming in clutch with that first comment. We also got Joe Nichols saying he's third, which means there's somebody else that is blocking. Who was second? Oh, maybe I think Piper. I think Army Piper was second.
Army Piper was second.
Yeah. All right. We also got John Kahn is here. So's Majid is here. Mr. J. Pashis is here. Who else do we have? Ooh, look at that. Got a nice little jingle. Grand Roofing Incorporated. And I remember you were talking about he had this chat. Someone else commented later. They were like, this chat in this community is terrible for my productivity as I'm trying to get stuff done. Let's keep reading some more names here, though. Let's see. A lot of same people commenting in there early. But let's keep going down, scrolling. A lot of Eric Wallen, a lot of Grand Roofing Incorporated. Crypto JMP is here. Eric Brubaker is here. Crypto Trades. Let's see who else. CBD Suddy, Crypto JMP. Lots of stuff. Tom Wilkes is in chat with that blue wrench. Good to see Tom Wilkes. I know he is very, very busy down there in St. Pete, but it's good to see him here. Cilantro Island with the yo, my bro, Utch love. Utch to you too, Cilantro Island. T Shroom commenting in here. Z Canceling Radio is here. Let's get a couple more names. Greg Gressick, Silver Dollar, Gia S. Who else? Might go and call it there. Let's see if I find one more name. The Kid. This is Colorado, Minnesota, but it says the Kid coming. And then Rick Wilson. Thank you to everybody who is here in chat right now. Again, we got over 70 people watching. Only 48 likes. Go ahead and smash those like buttons. Let's go back here. I mean, this is going to be a thing. We're going to keep talking. We're going to kind of speculate here. I haven't gotten to give my take yet on this yet, but we are seeing some massive wicks above and below a red 5-minute candle for Bitcoin. So here, while we were reading green names, we had shot up to 28,800, literally skinned our hairs, the top of the hairs of Bitcoin's head on 28,900 over here on the Coinbase chart. Then we proceeded while reading names to dip all the way back down to 28,200. So that volatility got very, very, very intense. We're back up, hovering on 28.6. The reason for this is, and this is kind of what I didn't get to talk about this beforehand. I was fully expecting 25 basis points. Very easy for me to say now that we know for certain it is 25 basis points. But here's the good news about that. The market knew it was 25 basis points. Let's see. Right before I went live, I haven't updated this. There was still an 83% chance prediction we're going to see 25 basis points. When you update this, it's just going to go ahead and move me over to May. No, okay. So it's still giving me the prediction for March. Let's look at May real quick. Next month, already in the lead right now would be another 25 basis points, 50% predicting another 25. I think the market had really kind of baked in the 25 basis points here. And that's why we're kind of seeing the market act a little volatile, but not moving absolutely crazy. This is a good sign for Bitcoin and takes us into the next part of what I'm predicting and what I think could happen later on here in just about 25 minutes or so. And that is we get to the deep, deep questions of what the future looks like. What is the money printing going to look like? What are the concerns with trade now internationally, now that we know that Russia and China are kind of teaming up behind the scenes to at least threaten the power of the U.S. dollar? What does that mean for the U.S. dollar ultimately? Does that give Jerome Powell hesitancy to want to increase its flow and allow countries to continue to trade there? Because that's really interesting. You would think that he would say, all right, let's increase the power of the dollar so that they can't threaten it. But something we covered months and months ago was even as the dollar was being inflated like crazy, some other currencies, some other fiat currencies are being inflated out the wazoo ridiculously. And there was a major concern that if the dollar got too powerful, certain countries were just going to have to shut down trade because they would be too concerned about their debt in USD. Do we see Jerome Powell potentially feel a little pressure to go back to quantitative easing and allow the power of the dollar to diminish a little bit? That would encourage countries to continue to want to have a lot of trade in USD. A lot of things that could happen there. That's an issue that I'm definitely not an expert on. Cannot wait to get a guest on that can explain to us more of the significance of what would happen if Russia and China end up kind of pulling some power away from the dollar, what the dollar needs to do. My point, though, is I cannot wait for a journalist to kind of grill Jerome Powell on this. Who knows? Maybe Jerome Powell doesn't even really know what he was supposed to do with that one. T-Shirt, what are your thoughts about that?
Well, I'm going to have to unshare and then reshare. So give me just a second. I didn't think about that. I apologize. But this is coming in to us live. So let's take a look at this. This is the text comparison from the statement. So here they issue a Federal Reserve issues FOMC statement. This is the FOMC statement. And then there has been some people who've already scratched it up. So what were the changes? The red lettering highlights the changes that are made. Let's see if it provides any guidance. Red line, FOMC red line, note language about ongoing increases in the target range will be appropriate, removed, and replaced with some additional policy firming may be appropriate. So this is the one that's highlighted the most here is ongoing increases in the target range, some additional policy firming may be appropriate. I'm not exactly sure what that means.
What does that mean?
But that was changed. Okay, so here some geopolitical stuff was removed. So the Russia war against Ukraine is causing tremendous human and economic hardship. That is removed.
Okay.
And then it was replaced, not necessarily directly replaced, but text that was inserted that was not there before is the following. The U.S. banking system is sound and resilient. Nice. Recent developments are likely to result in tighter credit conditions for households and businesses and to weigh on economic activity, hiring, and inflation. The extent of these effects is uncertain. The committee remains highly attentive to inflation risks. So inflation risks did not go anywhere, but they are now issuing a kind of a concern that the credit crunch that the banks are experiencing is going to bleed into household and businesses. Mm-hmm. So yes, a scarcity of credit is now kind of the era that we're moving into. Okay, that's that paragraph. That's the second paragraph. We could read more, or Tim and Piper, we could kind of just digest that.
So what I'm looking at here, go ahead and leave his screen up there. Well, let's go back. Let's share T-Shroom screen again, because I'm looking at a line there. So this was something I mentioned earlier. I was very interested to see what Jerome was going to say about that 2%. So that line above the red, kind of in the middle there, the committee seeks to achieve maximum employment and inflation at the rate of 2% over the longer run. Oh, so that's not even talking about inflation. I might have read that wrong. So the committee seeks to achieve maximum employment and inflation at the rate of 2% over the long run. Is he talking about inflation still there? Because the last comment there, committee remains highly attentive to inflation risk. That's kind of a vague little detail. The committee decided to raise the target range for the federal funds rate. Okay, that's just telling us what they're raising. There's aspects of this, and I love the part in here that they talk about how the banks are resilient. At least they changed up the wording.
Right.
Everyone else in the government kept saying the words, banks are safe. Banks are safe. Mm-hmm. Banks are safe. Go to sleep. Do not look at what we're doing behind closed doors. Mm-hmm. Like the Wizard of Oz. Do not pay attention to the man behind the curtain. Mm-hmm. At least they decided to change the word up here and said banks are resilient, but it's still part of that narrative. They're really pressing home. The marketing that's going into telling people that banks are safe, despite the fact that they very clearly are in risky times right now, is you gotta give them some, they've been working their butt off over there to push that story. I'm interested to see how he answers questions. It looks to me, when I'm reading this report, my first take on it is they're going to try to come out with as much. Don't be surprised if Jerome Powell, when he gives his initial speech, is trying his very hardest to look like everything's okay. This isn't against what we thought. We're going to continue to tackle inflation. Banks are safe. They're resilient. But it's going to be the questions, especially when they start asking him, well, are they going to be turning money printers back on? Because that's what we do know. Everything that they've been implying, Janet Yellen, Janet Yellen, the White House, they've all been talking about these systems that they have in place to stave off things. We all know those systems are printing money. What does Jerome Powell say? Does he flat out deny it? And is that denial a truth or a lie? Or does he give in and say, you know what? Yes, we're going to have to be printing some more money. We're going to make sure that this doesn't extend too far. In which case, it's like, well, guess what, Jerome Powell? A 25 basis point rate hike means absolutely booty if you're going to go ahead and raise rates at this. You're going to go ahead and print money at the same time.
Yes.
So that's what I'm very, very fascinated to find out more about. I'm going to throw it over to you, Piper. What are your thoughts about? Oh, you have more.
Well, I do want to hear what Piper has to say, but let's quickly look through the main headlines here of how the media is interpreting this. So Wall Street Journal says Fed raises interest rates by 0.25%, leaving it very bland. Let's read this summary here. The Federal Reserve raised rates by 0.25 point to fight high inflation and signaled greater uncertainty about the future, increases amid banking stress. Okay, CNBC, Fed hikes rates by 0.25%, indicates increases are near an end, excuse me. BBC Business, I don't know that let me refresh and see. U.S. interest rate decision, world is watching. Okay, so they're not up to date yet. So that's going to be kind of your media roundup. Piper, what's on your mind at this point? What are you thinking?
A little muted.
There we go. I mean, at this point, I'm waiting to see. I think we're going to have a decent pullback today, but we're still operating within the 2.5% move. If you take that bottom wick to the top wick from this morning, we're still in that less than 3 to 5% right now. We're right under 3% movement right now. But so we got some people in the chat asking about, are we going to be showing the speech? Yes, we are absolutely showing the speech. We are going to stay live with you the whole time. So don't go anywhere. Stay right here, hit the like button, subscribe, and enjoy the show with the Investing Bros. So,
the SEP is out. The Summary of Economic Projections. I have it pulled up if you guys want to take a look at the new dot plot.
Let's take a look at that. Oh, yes, the dot plot is going to be very important.
Oh, yes. The sacred dot plot has been released in accordance with tradition. All right, so here we are. Let's see. So change in real GDP. Let me blow this up for you guys. Change in real GDP. I don't know what was changed. Let's just go ahead and look at the dot plot. Let's not try to digest something we don't understand. All right, so here it is. Actually, I would say that it has come up. So it might not even be useful to look at this without having the older one pulled up. So I'm going to pull that one up too. But in the meantime, Tim, maybe if you can see this, you could kind of interpret what you're seeing there.
Yeah, so scroll in here just a little bit because I'm looking at the percentages, or maybe I can scroll my screen up to see what you're doing a little bit more. What I'm looking at for 2023 at this point, very interesting to go over here and look at CME Futures tool. You see all those dots right there in 2023. They're sitting just north of 5. All right. So what that would imply is that at this point, the average is still going to be there. They're still anticipating. This is not that much of a change. They're still anticipating getting up between 5 to 5.25. You can see there's one dot below there that thinks it should be at 4.75 to 5. There's 3 that think 5.25 to 5.5. And then there's another 3, 5.5. To 5.75, and then there's the one person thinking that we need to go all the way to 5.75 to 6. All right, what you're going to look at is it's going to be the average, and again, taking all those dots into consideration, the average is going to be sitting down here at 5 to 5.25. That goes in line with something Jerome Powell said a while ago, that the target rate was about, I believe he said 5.1, which I don't know why he says 5.1. I mean, he's saying that because he wants 5.1, but we all know that means 5 to 5.25. So it's actually, while these dots are updated, nothing changed. They are still very much anticipating that by the end of 2023, we're going to be sitting, if this meeting that we just had took us to 4, let's see, this one took us to 475 to 5, right? So they're saying, let me make sure I'm doing this correctly. Yeah, okay. Then in May, the prediction at this point is more than likely to go another 25 basis points up to 5 to 5.25. That should do it for the rest of the year. There should be pauses. Let's see if they want to go a little higher. It's looking like they're probably just going to stay around 5 to 5.25 for the rest of the year. Their anticipation is no cuts. Now, this could change a lot with more data coming out.
So really quick, I have the other one pulled up, the one from December. So you can take a look at that. So this is the one from December 14th. again, and this is the statement of economic projections, summary of economic projections, excuse me. The biggest change that I saw was this 2024 prediction has become more condensed. So here you'll notice it's more elongated, whereas here it's more condensed. Now, does that mean a whole lot?
Go back to it. That was December.
This is December 14.
So the reason why that doesn't, I think they updated it since then, because what this one would say, if you're looking at to end right there, okay, and then, never mind, I'm reading this wrong because that's the end of 2022. Okay, never mind. My objection was not needed. Keep going, T-Shroom.
Yeah. So 2024 is more condensed, less elongated. So that means that there's more agreement of where the federal funds rate will be in 2024 in the future.
Zero Hedge just dropped on Twitter the side by side December to March.
Oh, perfect. Yep. There it is. I got it right here. All right. So you can, this is perfect. So you can see here, right. So just a very, very minute condensing of that. In fact, it's almost not even, it just came off the 3. So it's no longer slightly above 3 for 2024. I mean, at this point, we're kind of pulling at straws because this is pretty much identical. That's the takeaways. This is identical.
Almost, yeah.
Yeah. So they're using a little bit of more spacing in between the dots. I'll notice that. So they have changed some formatting things there, but that obviously is not going to move markets, guys. Let's see if BBC News has their story up yet. No, still no headline.
I just want to tell you what Z Canceling Radio just said in chat, though. He said, "You guys are better than CNBC, and I'm watching both live. This is unbelievable."
Thank you very much.
I appreciate it.
It's CNBC, but thank you very much.
Yeah.
Something I think would be interesting here, though. So this is after a lot of chaos. Remember, Caleb Franzen talked about this. He said that Jerome Powell and the Fed were going to say that going to act like this was all part of the plan, right? Something clearly shook them, though, that the CME Futures tool got all screwy. And at one point predicted we were going to drop by as much as 100 basis points from where we currently were by the end of the year. They're coming back. They're regaining their confidence. But that was definitely enough to shake the confidence that even Jerome Powell and the Fed really know what the rest of the year is going to look like. They got to play their part. They got to pitch a story of saying, nope, everything's good. We got this under control. We're going to go ahead and continue to fix and head towards 2% inflation. But I'm telling you right now, I think that people are going to start calling the bluff. They're going to watch the banking problems happen. They're going to see them turn the money printers back on. They're going to watch this current government, which has a terrible track record of knowing how to spend money, continue to spend money in some of the worst ways possible. And it's going to back Jerome Powell into a corner where eventually they're going to have to say, all right, never mind. We're going to back off. We're going to move into quantitative easing. Again, I think we're going to see, even though I'm still very interested in the FOMC meetings moving forward. Remember how we talked about yesterday how these FOMC meetings, every single one gets more important because it's the most crucial tool in kind of understanding what the Dixie and Bitcoin are going to do. I think that we actually might move into a season or period of time where the FOMC meetings might not have the same significance as previous ones. What's going to be more important is watching what is happening with money printing. I think we're going to go away from interest rates being the biggest problem to being what are we doing with printing money. When we print a lot of money, we're going to watch crypto explode. If they go in a season where they're not printing money, we might see crypto kind of pause or start to decline. What was your thoughts, T-Shroom?
So what I'd like to do, Tim, go ahead and pull up the CME Futures. Let's see how they're reacting to this new print. Yeah. And then while you're doing that, we can be on my screen, kind of taking a look here at the bonds, the way that the treasuries are reacting. So first thing I'm noticing is that the yields are coming down on the younger bonds here. So the 2-year is down 2.8% here at 219. That's the time, 219, sorry, Eastern Standard Time. And then the 5 years down more. So the 5 years leading yields lower, down 3%. And the 20-year is down 1.4. And the 30-year is the one holding on the most, down 1.4. Okay, so a quick interpretation of that, and Piper, feel free to correct me if I'm wrong with that. Okay, but let me give this a shot. So what does this mean? What is the bond market? How is the bond market reacting to this? Well, if yields are coming down, that means simply that bonds are getting bought, right? So there's less of an incentive needed for Americans to come out and buy bonds. That's the way that those instruments are set up to operate. It's been like that since the Medicis, right? Okay, so what does that mean? If bonds are getting bought more, that means what you were saying this morning, Piper, is there is a phenomenon taking place where, and it doesn't seem that aggressive for what we've seen in past weeks, but folks are trading their money that's in deposit accounts for treasuries. And maybe that money's coming out from who knows where. Maybe it's coming out of, timber. People are selling out their timberland, or they're selling out copper. So the money could be flowing from anywhere, but it's coming from somewhere. And one of the things you said this morning, Piper, was that it could be coming from bank deposits. So from savings. So Piper, what are you seeing that the bonds tell us about this 25 basis point hike? And then Tim, I want to throw it to you. Not that it's my right to throw it to anyone necessarily.
How about you toss it?
Yeah, I'll give it a light, gentle toss. To check out those CME futures.
Yeah, so that's exactly what I'm seeing right there. Is they're being bought up. And if they weren't being bought up, then the rate on those would be going up to over 5% yield, which, who's going to keep their money in a bank when you've got that type of risk-free offering, So yeah, that's exactly what's happening. And I think this is going to hurt banks. If you are invested in banks, not financial advice, I would be watching those earnings reports over the next quarter to 2 quarters, because they're going to be ugly. Everything that they need to keep money in there so that they can do fractional reserve banking to lend it out and do the other side of money printing, because that's what happens. You guys may not know this, but it's not just the Fed that prints money. Every time a bank takes your deposit and does fractional reserve banking, they only have to keep 10% reserves on hand to back up deposits. As of March of 2020, they passed that law. So
now, wait a minute, Piper. Wait a minute.
Come on, Piper.
Only crypto exchanges do things like that.
Oh, no. I would love to say that everybody out there is not a Caroline, but nope. Whole bunch of Carolines in the banking industry. So
you're just blowing my mind right now, Piper.
So when they do that, when they only have to hold that 10% on hand, they're lending out your money multiple times. They are producing debt out of thin air, and debt is money. So they're printing money. These people are pulling their money out. I think we're going to see some major pain coming to the banking stocks over the next 2 quarters. And I think that those people pulling their money out today and moving into those yields, which is what you're seeing going on there, mass demand for yields, bringing down their numbers. I think the banks are going to be paying the price for this, and it's because of that 25 basis points. That's the reason that I did not think that the Fed Reserve would do that, because the second and third order effects, some Intel lingo there, second and third order effects of 25 basis points is going to be felt for the next 6 to 9 months. And we're going to see it in the earnings reports. So, but I do want to remind everybody, 7 minutes, we will be going live with Jerome Powell on here. He's our guest today. He's going to be coming on to speak for us. So stick around, 7 minutes.
Now that you mention that, Piper, I would actually like to go ahead. I'm going to play the background music from the live stream. Let's see how that's coming through. Just to do a little technical.
Let's jump over there.
We never have any technical issues on this show, thankfully. But I do want to just make
you guys can check out our little setup that we got here going for you today.
Yeah. Beautiful music.
Now, I am going to switch over to this really quickly. So just bear with me, folks. Boom. Now you should be able to hear the lovely stylings of the Federal Reserve's musical director.
Good branding move by the Federal Reserve. I like the music.
Does the music
Seems
sound good?
Par.
Okay, we can see it.
Yeah.
And now there's no music, so hold on. Okay, it's coming.
No, it was a pause. The score had a little bit of a break.
Yes.
And then while we're waiting on this, because we still got like 5.5 minutes or so, let's go ahead and let's take a look at the tool. Go over my screen here, Piper, as long as you don't break anything. So this is really crazy. I'm going to refresh just to make sure about this. So even though the number is in, and it is
I never break anything for the record ever.
Yeah, that's true. Even though it's official, there's still technically a 1.1 chance that we go 50 basis points at this point. We're only 98.9% sure that the numbers we just heard here.
Jerome's going to come out at the press conference. They said 25 in the report.
Misprint.
I don't know how that got in there.
Misprint.
It's actually 75.
Yeah. Let's keep moving forward there here in May right now. So it is tight. It is tight between a 25-point raise, 51% saying a 25-point raise again in May, 47.9% saying we're going to pause in May. So keep your eyes there. 0.6% chance we're going to do 50 basis points. So we got to keep that one over there. June, moving forward into June. At this point, so it's saying if we don't cut in May, the leading guess is that we're going to cut in May back down to 475 to 5. 37% saying we're staying up to 5.25. 13% saying we're cutting 50 basis points, going all the way down to 450 to 475. 0.4 saying nope, we're going up to 525 to 550. Don't know who's the one predicting those. I don't know. We'll have to see. To be fair, it wouldn't be the worst bet in the world when you're betting on $1 million Bitcoin in 90 days.
Right.
He wins the cake. He eats the cake for worst prediction recently. Well, moving forward into July, the expectation, I'm going to stop saying 25 basis points or 50 raises or cuts or whatever. They're expecting it to be 450 to 475. So they're saying at some point we're going to have a cut between now and July. September, let's see what they're saying. 450 to 475 in September. Let's see, in November, they're predicting another cut. Wow, 425 to 450 is the leading one down there. Where it's close, though, to staying 450 to 475. And then we come over here to December, 425 to 450. So this is crazy. Despite the fact that we got our 25 basis points and they're predicting another 25 basis point hike in May, something about the CME Futures tool, they are predicting that by December, we are going to be getting some cuts. So they are not buying that dot plot. Can you go ahead and show that dot plot again, T-Shroom?
I can, yeah.
Because we were talking about that. That dot plot is implying that the Fed is planning on finishing the year between 5 to 5.25. But CME Futures is saying, liar, you guys are going to finish at 475. Let me make sure. I think they said 475. I think they're saying 425 to 450. Their CME Futures is predicting in the year at 425 to 450, 75 points lower than what the Fed is telling us with their dot plot. Who do you believe? Do you think the Fed is going to stick to their guns, or do you think that CME Futures knows something and they're predicting that that cut is going to actually come to fruition? Again, would make a lot of sense, especially what we just talked about with bonds and yields, the way they're going to look. The fact that all the messaging right now is banks are safe, banks are resilient, banks are great, and yet we're looking at the data points and saying they're everything but that way. Jerome Powell, Janet Yellen, Joe Biden, Jill Biden too. And so we'll see. We'll see.
Auntie Warren.
I don't know has Auntie Warren come out and said anything about where she thinks. She just says she doesn't want 2 million people to lose their jobs. I don't think she's actually made any type of observation about where she thinks interest rates or inflation. She's implying that she wants them to be lower. But yeah, we'll see. Yeah, maybe Auntie Beth knows something too. Auntie Beth must be in the CME Futures prediction because she's saying that it needs to go lower. So we'll have to see. Out of curiosity, in chat, I want to hear your guys' opinions. We don't talk about this that often. Not that any of us get to vote anyway. I'm going to start off with people on screen while we have about a minute and a half. T-Shroom, you get a vote in where we should end the year in terms of interest rates. Where do you want us to end December with?
Goodness. I would want
keep in mind right now we're 475 to 5.
We've got music coming in on the thing.
Yeah, there's going to be a little bit of time before they come in.
Yeah, let us know in the chat if you can hear this music. I'll turn up the volume a little bit. I mean, it's pleasant. It's
loud. It's loud. You just turned up. It's very loud.
Okay. All right. I don't have a great answer for you, Tim. I mean,
then I don't want to care. If you don't have an answer for me, Piper, what do you got for me? What do you want? What would you vote for?
I got thrown off by the loud music.
Oh my
goodness. Triggered me over here. Yeah, see, Rick Wilson said very loud. T-Shroom, you got to turn that down a little bit, man. It's so loud.
Is it still loud?
Yeah, they're saying turn it down.
Yeah. Well, they might be a little bit behind, but it wouldn't hurt to turn it down just a little. We can always turn it back up. All right, so neither one of you guys are going to answer my question. Chat, what do you guys think? If you could vote on the interest rates, let me know in chat what you would say. I'm going to go with, it's really crazy. I'm going to go with a cut. I'm going to say if I could vote, I would go ahead and go low. Let's go back to about 4 to 4.25. That would be my vote.
4.75 is what Z Canceling Radio said.
He said 475 is what he wants.
Yeah, and Rick Wilson said it's still too loud. Speak up, Tim.
Yeah, you can go ahead and throw us on to the FOMC scene here, because we now have the press conference beginning.
Here we go.
And we have the American flags and the Board of Governors flags all in staggered form, as is tradition. We have the blue curtain behind the flags.
Were you, T-Shirt, were you live with me the press conference that there was, while we're waiting on Jerome Powell to come out, there was the flag right behind him had the worst stain on it, like someone spilled ketchup on the American flag.
Yeah, it was brutal.
It was rough. It looks like they've changed the flags.
Yeah. And
here he comes.
There he is. I might need to turn this up. Let me know quickly.
Good afternoon. Before discussing today's meeting, let me briefly address recent developments in the banking sector. In the past 2 weeks, serious difficulties at a small number of banks have emerged. History has shown that isolated banking problems, if left unaddressed, can undermine confidence in healthy banks and threaten the ability of the banking system as a whole to play its vital role in supporting the savings and credit needs of households and businesses. That is why, in response to these events, the Federal Reserve, working with the Treasury Department and the FDIC, took decisive actions to protect the U.S. economy and to strengthen public confidence in our banking system. These actions demonstrate that all depositors' savings and the banking system are safe. With the support of the Treasury, the Federal Reserve Board created the Bank Term Funding Program to ensure that banks that hold safe and liquid assets can, if needed, borrow reserves against those assets at par. This program, along with our long-standing discount window, is effectively meeting the unusual funding needs that some banks have faced and makes clear that ample liquidity in the system is available. Our banking system is sound and resilient with strong capital and liquidity. We will continue to closely monitor conditions in the banking system and are prepared to use all of our tools as needed to keep it safe and sound. In addition, we are committed to learning the lessons from this episode and to work to prevent events like this from happening again. Turning to the broader economy and monetary policy, inflation remains too high and the labor market continues to be very tight. My colleagues and I understand the hardship that high inflation is causing, and we remain strongly committed to bringing inflation back down to our 2% goal. Price stability is the responsibility of the Federal Reserve. Without price stability, the economy does not work for anyone.
Hey, Jim, turn volume up just a little bit.
In particular, without price stability, we will not achieve a sustained period of strong labor market conditions that benefit all. The U.S. economy slowed significantly last year, with real GDP rising at a below-trend pace of 0.9%. Consumer spending appears to have picked up this quarter, although some of that strength may reflect the effects of swings in the weather across the turn of the year. In contrast, activity in the housing sector remains weak, largely reflecting higher mortgage rates. Higher interest rates and slower output growth also appear to be weighing on business fixed investment. Committee participants generally expect subdued growth to continue. As shown in our summary of economic projections, the median projection for real GDP growth stands at just 0.4% this year and 1.2% next year, well below the median estimate of the longer-run normal growth rate. And nearly all participants see the risks to GDP growth as weighted to the downside. Yet the labor market remains extremely tight. Job gains have picked up in recent months, with employment rising by an average of 351,000 jobs per month over the last 3 months. The unemployment rate remained low in February at 3.6%. The labor force participation rate has edged up in recent months, and wage growth has shown some signs of easing. However, with job vacancies still very high, labor demand substantially exceeds the supply of available workers. FOMC participants expect supply and demand conditions in the labor market to come into better balance over time, easing upward pressures on wages and prices. The median unemployment rate projection in the SEP rises to 4.5% at the end of this year and 4.6% at the end of next year. Inflation remains well above our longer run goal of 2%. Over the 12 months ending in January, total PCE prices rose 5.4%, excluding the volatile food and energy categories. Excluding those, core PCE prices rose 4.7%. In February, the 12-month change in the CPI came in at 6%, and the change in the core CPI was 5.5%. Inflation has moderated somewhat since the middle of last year, but the strength of these recent readings indicates that inflation pressures continue to run high. The median projection in the SEP for total PCE inflation is 3.3% for this year, 2.5% next year, and 2.1% in 2025. The process of getting inflation back down to 2% has a long way to go and is likely to be bumpy. Despite elevated inflation, longer-term inflation expectations appear to remain well anchored, as reflected in a broad range of surveys of households, businesses, and forecasters, as well as measures from financial markets. The Fed's monetary policy actions are guided by our mandate to promote maximum employment and stable prices for the American people. My colleagues and I are acutely aware that high inflation imposes significant hardship as it erodes purchasing power, especially for those least able to meet the higher costs of essentials like food, housing, and transportation. We are highly attentive to the risks that high inflation poses to both sides of our mandate, and we are strongly committed to returning inflation to our 2% objective. At today's meeting, the committee raised the target range for the federal funds rate by a quarter percentage point, bringing the target range to 4.75% to 5%. And we are continuing the process of significantly reducing our securities holdings. Since our previous FOMC meeting, economic indicators have generally come in stronger than expected, demonstrating greater momentum in economic activity and inflation. We believe, however, that events in the banking system over the past 2 weeks are likely to result in tighter credit conditions for households and businesses, which would in turn affect economic outcomes. It is too soon to determine the extent of these effects, and therefore too soon to tell how monetary policy should respond. As a result, we no longer state that we anticipate that ongoing rate increases will be appropriate to quell inflation. Instead, we now anticipate that some additional policy firming may be appropriate. We will closely monitor incoming data and carefully assess the actual and expected effects of tighter credit conditions on economic activity, the labor market, and inflation. And our policy decisions will reflect that assessment. In our SEP, each FOMC participant wrote down an appropriate path for the federal funds rate based on what that participant judges to be the most likely scenario going forward. If the economy evolves as projected, the median participant projects that the appropriate level of the federal funds rate will be 5.1% at the end of this year, 4.3% at the end of 2024, and 3.1% at the end of 2025. These are little changed from our December projections, reflecting offsetting factors. These projections are not a committee decision or plan. If the economy does not evolve as projected, the path for policy will adjust as appropriate to foster our maximum employment and price stability goals. We will continue to make our decisions meeting by meeting based on the totality of the incoming data and their implications for the outlook for economic activity and inflation. We remain committed to bringing inflation back down to our 2% goal and to keep longer-term inflation expectations well anchored. Reducing inflation is likely to require a period of below-trend growth and some softening in labor market conditions. Restoring price stability is essential to set the stage for achieving maximum employment and stable prices over the longer run. To conclude, we understand that our actions affect communities, families, and businesses across the country. Everything we do is in service to our public mission. We at the Fed will do everything we can to achieve our maximum employment and price stability goals. Thank you. I look forward to your questions.
All right, here we go.
Thank you. Colby Smith with the Financial Times. How confident is the committee that the recent stress that we've seen and you've alluded to is contained at this point, and that deposit flight among mid-sized lenders in particular has ceased?
Thanks. So I guess our view is that the banking system is sound and it's resilient. It's got strong capital and liquidity. We took powerful actions with Treasury and the FDIC, which demonstrate that all depositors' savings are safe and that the banking system is safe. Deposit flows in the banking system have stabilized over the last week. And the last thing I'll say is that we're undertaking a thorough internal review that will identify where we can strengthen supervision and regulation.
Okay, just a quick follow-up. I mean, given all of the stress and the uncertainty that you've also alluded to in the statement, how seriously was a pause considered for this meeting?
So we did consider that in the days running up to the meeting, and you see the decision that we made, which I'll say a couple things about. First, it was supported by a very strong consensus, and I'll be happy to explain why. And really it is that the intermeeting data on inflation and the labor market came in stronger than expected. And really before the recent events, we were clearly on track to continue with ongoing rate hikes. In fact, as of a couple of weeks ago, it looked like we'd need to raise rates over the course of the year, more than we'd expected at the time of the SCP in December, the time of the December meeting. We are committed to restoring price stability, and all of the evidence says that the public has confidence that we will do so, that we'll bring inflation down to 2% over time. It is important that we sustain that confidence with our actions as well as our words. So we also assess, as I mentioned, that the events of the last 2 weeks are likely to result in some tightening of credit conditions for households and businesses, and thereby weigh on demand, on the labor market, and on inflation. Such a tightening in financial conditions would work in the same direction as rate tightening. In principle, as a matter of fact, you can think of it as being the equivalent of a rate hike, or perhaps more than that. Of course, it's not possible to make that assessment today with any precision whatsoever. So our decision was to move ahead with a 25 basis point hike and to change our guidance, as I mentioned, from ongoing hikes to some additional hikes some policy firming may be appropriate.
He means one more hike.
Going forward, as I mentioned, in assessing the need for further hikes, we'll be focused, as always, on the incoming data and the evolving outlook, and in particular on our assessment of the actual and expected effects.
That sent the SPY higher.
Because he was vague, and we know what his vagueness means.
Mm-hmm.
Mr. Chairman, can you explain the difference between ongoing rate increases and firming? Does firming imply a rate increase per se, or could policy firm without you increasing rates?
No, I think it's meant to refer to our policy rate. Really, I would focus on the words may and some, as opposed to ongoing.
Meaning one.
Ongoing. So we clearly were, what we were doing there was taking on board trying to reflect the uncertainty about what will happen. I mean, it's possible that this will turn out to have very modest effects. These events will turn out to be very, very modest effects on the economy, in which case, and inflation will continue to be strong, in which case, the path will might look different. It's also possible that this potential tightening will contribute significant tightening in credit conditions over time, and in principle, if that means that monetary policy may have less work to do. We simply don't know. So.
Gold's having a good run right now.
The hike you did today could further exacerbate the problem in the banks?
No, I mean, with our monetary policy, we're really focused on macroeconomic outcomes. In particular, we're focused on this potential credit tightening and what can that produce in the way of tighter credit conditions. I think when we think about the situation in the banks, we're focused on our financial stability tools, in particular, our lending facilities. The discount window, and also the new facility.
Nick Timmeros of the Wall Street Journal. Chair Powell, in your testimony 2 weeks ago, you had indicated you thought the terminal rate would be higher. Obviously, that was before the stress in the banking sector. And I realize there's a lot of uncertainty, but can you explain at all to what extent your forecasts, or those of your colleagues, or those of the board staff incorporated today a material tightening of credit availability because of the stress in the banking sector, or are you waiting to see it in the data before you incorporate that potential tightening into your forecasts?
So, we've just come from an FOMC meeting, and the people who write the minutes will be very carefully counting. But I'll tell you what I heard. What I heard was significant number of people saying that they anticipated there would be some some tightening of credit conditions, and that would really have the same effects as our policies do, and that therefore they were including that in their assessment, and that if that did turn out not to be the case, that in principle you'd need more rate hikes. So some people did reflect that in their SEP forecasts. I think there may also just have been, remember, this is 12 days ago. We're trying to assess something that just is so recent, and it's people, it's very difficult. There's so much uncertainty. So December was a good place to start, and we wound up with very similar outcomes for December. And in a way, the data in the first 5 weeks of the intermeeting period pointed to stronger inflation and stronger labor market. So that pointed to higher rates, and then this latter part, kind of the possibility of credit conditions tightening, really offset that effectively.
To follow up, have you considered at all whether your primary tool, the funds rate, is going to be enough to sustain the kind of tighter financial conditions that you believe will be necessary without doing significant damage to the banking sector? Have you, for example, considered changing reserve requirements, selling assets out of the system, open market account, as a way to better achieve tighter financial conditions that don't accelerate deposit erosion, for example, from banks?
We know that we have other tools in effect, but no, we think our monetary policy tool works.
Good, Piper.
And we think, many banks, our rate hikes were well telegraphed to the market, and many banks have managed to handle them.
Whoa, it's going, man.
Mm-hmm. Well,
Hi,
that
Victoria.
worked.
I wanted to ask, you, along with the FDIC and the Treasury, the Fed Board decided to invoke the systemic risk exception to allow uninsured depositors to be protected at these two banks. And I was just wondering if you could speak to why that decision was made. Was it purely a confidence issue, or was there a concern that there would be some sort of economic contagion or financial contagion from the failure of these banks?
The issue was really not about those specific banks, but about the risk of a contagion to other banks and to the financial markets more broadly. That was the issue.
Okay, and then can you also, just to follow up, can you speak to the role that you will be playing in the Fed's internal investigation on its supervision and regulation?
So Vice Chair Barr is of course leading that review, and he's responsible for it in his capacity as Vice Chair for Supervision. I realized right away that there was going to be a need for a review. I mean, the question we were all asking ourselves over that first weekend was, how did this happen? And so what we did was early Monday morning, we sat down and said, let's do this. And he was obviously going to lead it in his capacity. So I don't, my role was to announce it, and I get briefed on it, but I'm not involved in the work of it.
Microsoft running for a close to an all-time high here.
Chair Powell, Howard Schneider from Reuters.
Sorry,
So I
not
want to go back to your February
It's
press conference. You
multi-month
mentioned
high.
the word disinflation, I believe, 9 or 10 times, a process that you felt was, I forget the word you used, but gratefully underway or something like that. Is disinflation still occurring in the U.S. today?
Yes. I mean, what actually happened, Howard, was I got the question 12 times. So maybe it's a feature, not a bug. But yeah, absolutely the same. The story is intact. So it's really three parts, right? Goods inflation has been coming down now for 6 months. It's proceeding more slowly than we would have liked, but it's certainly proceeding. Housing services is really a matter of time passing. We continue to see the new leases being signed at much lower levels of inflation. So that's 44% of the core PCE index, where you've got a story that's ongoing. Where we didn't have in February, and we still don't have now, is a sign of progress in the non-housing services sector. And that is,
Rat bro.
That's just something that will have to come through
This was the
softening
most
demand
confident answer he's
and
given.
perhaps
this
some
entire
softening
press
in labor
conference.
market conditions. We don't see that yet. And that's of course 56% of the index. So the story is pretty much the same. I will say that the inflation data that we got, to your point, really pointed to stronger inflation.
If I could follow up on that, I was curious why you don't see more coming from the credit crunch, because it seems to me that's something that you'd actually welcome to a degree and expect. And are you not seeing more coming from that because you don't know, or because you just don't want to have another round of wishful thinking?
So it's really just a question of not knowing at this point. There's a great deal of literature on the connection between tighter credit conditions, economic activity, hiring, and inflation. Very large body of literature. The question is, how significant will this credit tightening be, and how sustained will it be? That's the issue, and we don't really see it yet. It's so people are making estimates. People are publishing estimates, and it's very kind of rule of thumb guesswork almost at this point. But we think it's potentially quite real, and that argues for being alert as we go forward, as we think about further rate hikes. For us, we'll be paying attention to the actual and expected effects from that.
Gina. Hi, Chair Powell. Gina Smilik from the New York Times. Thank you for taking our questions. I wonder if you could talk a little bit, I know that you've got your internal review coming, but I wonder if you could talk a little bit about what you think happened with oversight at Silicon Valley Bank, and whether this suggests that something about regulation and supervision needs to actually change going forward. And I wonder, how can the American people have confidence that there aren't other weaknesses out there in the banking system, given that this one got missed, as you noted?
So let me say what I think happened, and then I'll come to the questions around supervision. So at a basic level, Silicon Valley Bank management failed badly. They grew the bank very quickly. They exposed the bank to significant liquidity risk and interest rate risk, didn't hedge that risk. We now know that supervisors saw these risks and intervened. We know that the public saw all this. We know that SVB experienced an unprecedentedly rapid and massive bank run. So this is a very large group of connected depositors, concentrated group of connected depositors, and a very, very fast run, faster than the historical record would suggest. So for our part, we're doing a review of supervision and regulation. My only interest is that we identify what went wrong here. How did this happen is the question. What went wrong? Try to find that. We will find that. And then make an assessment of what are the right policies to put in place so that it doesn't happen again, and then implement those policies. It would be inappropriate for me at this stage to offer my views on what the answers might be. I simply can't do that. Vice Chair Barr is leading this, and I think he's testifying next week. So, but that will be up to him. So that's really where it is. The review is going to be thorough and transparent. It is clear to your last question. It's clear that we do need to strengthen supervision and regulation, and I assume that there will be recommendations coming out of the report, and I plan on supporting them and supporting their implementation.
And the final point, can we feel confident that these weaknesses don't exist elsewhere, given that they got missed at this bank?
These are not weaknesses that are at all broadly through the banking system. This was a bank that was an outlier in terms of both its percentage of uninsured deposits and in terms of its
along
holding.
With the other four banks.
And again, supervisors did get in there, and they were, as obviously, they were on this issue, but nonetheless, this still happened, and so that's really the nature of the review. Is to discover that.
That was
Michael
to remember what to say.
Radio
that was
and television.
A prepared statement.
You've been very consistent in saying that the Fed would be raising interest rates and then holding them there for quite some time. Following today's decision, the markets have now priced in one more increase in May, and then every meeting the rest of this year, they're pricing in rate cuts. Are they getting this totally wrong from the Fed, or is there something different about the way you're looking at it, given that you're now thinking that moves might be appropriate as opposed to ongoing?
So we published an SEP today, as you will have seen, and it shows that basically participants expect relatively slow growth, a gradual rebalancing of supply and demand in the labor market, with inflation moving down gradually. In that most likely case, if that happens, participants don't see rate cuts this year. They just don't. I would just say, as always, the path of the economy is uncertain, and policy is going to reflect what actually happens rather than what we write down in the SEP. But that's not our baseline expectation.
Well, if I could follow up and ask, as you look forward into the rest of the year here, are you saying that what you see and the 5.1% basically consensus is based on it will be sufficiently restrictive, or is it leavened by the idea of you don't know what's going to happen? In other words, what should people think about in terms of how the Fed thinks about how far it is from the terminal?
It's going to depend. Remember, we're looking for purposes of our monetary policy tool, we're looking at what's happening among the banks and asking, is there going to be some tightening of credit conditions? And then we're thinking about that as effectively doing the same thing that rate hikes do. So in a way, that substitutes for rate hikes. So the key is we have to have policies got to be tight enough to bring inflation down to 2% over time. It doesn't all have to come from rate hikes. It can come from tighter credit conditions. So that we're looking at, and it's highly uncertain how long the situation will be sustained or how significant any of those effects would be. So we're just going to have to watch. In the meantime, and obviously at the end of the day, we will do enough to bring inflation down to 2%. No one should doubt that.
Let's go to Rachel Siegel. Hi, Chair Powell. Rachel Siegel from the Washington Post. Thank you for taking our questions. I know we've talked a bit about how Silicon Valley Bank was unique to a certain sector of the economy, but there's also growing concern that there are financial stability risks from the commercial real estate market and loans that will begin to roll over later this year and next, and that smaller regional banks also disproportionately hold those loans. Is there a risk that could mimic the kind of what we saw with SVB to banks that disproportionately are focused in commercial real estate?
So, we're well aware of the concentrations people have in commercial real estate. I really don't think it's comparable to this. The banking system is strong. It is sound. It is resilient. It's well capitalized.
It's strong and sound, but is it resilient?
I really don't see that as at all analogous to this.
And one other question: would you be open to an independent investigation separate from the Fed's probe?
I welcome. It's 100% certainty that there will be independent investigations and outside investigations and all that. So we welcome when a bank fails their investigations, and of course we welcome that.
Edward.
Thank you, Mr. Chairman. Edward Lawrence from Fox Business. Inflation has been rather sticky. So do you need help from the fiscal side to get inflation down faster?
Yes.
We don't assume that. We don't give advice to the fiscal authorities, and we assume that we take fiscal policy as it comes to our front door, stick it in our model along with a million other things, and we have responsibility for price stability. The Federal Reserve has responsibility for that, and nothing is going to change that. So we will get inflation down to 2% in time.
And if I can follow on that, but they're working, the spending that's happened is working against what you are doing, right? So it's prolonging inflation.
If you have to look at the impulse
He's looking
from spending,
down.
because spending was, of course, tremendously high during the pandemic, and then as the pandemic programs rolled off, spending actually came down. So the sort of fiscal impulse is actually not what's driving inflation right now. It was at the beginning perhaps part of what was driving inflation, but that's not really the story now.
Let's go to Neil Irwin.
He got to.
Isn't that the story?
He got.
Hi, Chair Powell.
It is the
Neil Irwin with
reality.
Axios. Two questions about aspects of the government's response on Silicon Valley Bank 2 weekends ago. First, why is this new bank funding facility done under emergency 13.3 authority as opposed to expansion of the discount window, changing the terms of the discount window that's been around a long time? And second, can you discuss the Fed's role in the FDIC guarantee of uninsured depositors and why there's $143 billion on your balance sheet last week supporting that deposit guarantee?
Sure. So 13.3 seemed like the right. We have a little more flexibility under Section 13.3. We've done quite a lot under discount window as well. We needed to do a special facility that was designed a certain way, so we did it under 13.3. Really no magic to that. It's only available in unusual and exigent circumstances, and it has to meet certain requirements, but it seemed to be the right place. So with the FDIC, we're lending to the, in effect, we're lending to the bridge bank. So that's where the funds came from, and it's a loan that's 100% guaranteed by the FDIC, so there's no risk in it for us.
Chris Rugaber.
Thank you, Chris Rugaber at Associated Press. The SEP suggests one more rate hike, as does the change in the language in the statement, in which suggests that you're perhaps nearing the end of a cycle of rate hikes. Do you feel, though, that if inflation remains high, you'll be able to resume additional hikes as needed, or have you somewhat tied your hands here with these signals about rate hikes coming to an end?
No,
Thank you.
absolutely not. No, if we need to raise rates higher, we will. I think for now, though, as I've mentioned, we see the likelihood of credit tightening. We know that can have an effect on the macroeconomy, on demand, on labor market, on inflation, and we're going to be watching to see what that is. And we'll also be watching what's happening with inflation and in the labor market. So we'll be watching all those things, and of course we will eventually get to tight enough policy to bring inflation down to 2%. We'll find ourselves at that place.
Hi, Chair Powell. Thanks for taking the question. Kyle Campbell with American Banker. I have a couple questions about the balance sheet. First of all, I'm curious at what point the financial supports that the Fed is extending through the discount window and through its enhanced lending facility might be at odds with the objective of reducing the balance sheet. And I'm also curious what your thoughts are on not just the availability of reserves, but the distribution of them throughout the banking system, and at what point you might be concerned about it being scarce for certain banks.
So people think of QE and QT in different ways. So let me be clear about how I'm thinking about these recent developments. So the recent liquidity provision that has increased the size of our balance sheet, but the intent and the effects of it are very different from when we expand our balance sheet through purchases of longer-term securities. Large-scale purchases of long-term securities are really meant to alter the stance of policy by pushing up the price and down the rates, longer-term rates, which supports demand through channels we understand fairly well. The balance sheet expansion is really temporary lending to banks to meet those special liquidity demands created by the recent tensions. It's not intended to directly alter the stance of monetary policy. We do believe that it's working. It's having its intended effect of bolstering confidence in the banking system and thereby forestalling what might otherwise have been an abrupt and outsized tightening in financial conditions. So that's working. In terms of the distribution of reserves, we don't see ourselves as running into reserve shortages. We think that our program of allowing our balance sheet to run off predictably and passively is working. And of course, we're always prepared to change that if that changes, but we don't see any evidence that that's changed.
Katarina. Hi, Chair. Katarina Saraiva with Bloomberg News. The minutes of the January-February meeting, the last meeting, indicate that you discussed the possibility of runs on non-bank financial institutions and the impact of large unrealized losses on bank portfolios. Can you talk a little bit more about that discussion, kind of what was talked about in light of that? And then why didn't the Fed, do anything about that at that point to ultimately prevent, what happened this month?
I mean, to be honest, I don't recall the specifics of that. It's quite an interesting 7 weeks, but I will tell you though that there have been presentations about interest rate risk. I mean, it's been in all the newspapers. It's not a surprise that there are institutions that have had unhedged long positions in long duration securities that have lost value as longer term rates have gone up due to our rate increases. So that's not a surprise. I think, as you know, as is now on the public record, the supervisory team was apparently very much engaged with the bank repeatedly and was escalating. But, nonetheless, what happened. And so that's really the purpose of one way to think about the review that Vice Chair Barr is conducting, is to try to understand how that happened and try to understand how we can do better and what policies we need to change. I mean, one thing is the speed of I'll come back to that, the speed of the run. It's very different from what we've seen in the past, and it does kind of suggest that there's a need for possible, regulatory and supervisory changes, just because supervision and regulation need to keep up with what's happening in the world.
Can you confirm whether or not the board knew about these escalations by the examiners in San Francisco?
I will have to come back to you on that. Yeah, I don't know.
Simon Urbanovich with The Economist. Thank you very much. Chair Powell, you've stated twice today that all depositors' savings in the banking system are safe. Are you saying that de facto deposit insurance covers all savings? Shouldn't Congress have a say in that? And just by way of example, if a bank with less than $1 billion in assets failed, are you promising to bail out all of its depositors? Thanks.
Well, I'm not saying anything more than I'm saying. So what I'm saying is you've seen that we have the tools to protect depositors when there's a threat of serious harm to the economy or to the financial system, and we're prepared to use those tools. And I think depositors should assume that their deposits are safe.
Go to Greg Robb.
Thank you, Chair Powell. Greg Robb from MarketWatch. I was wondering if you could give us a little bit more color. You gave just a little bit of color. You said during the first week of the Silicon Valley weekend, you said the question you guys asked was, how did this happen when you saw Silicon Valley Bank? So I was wondering if you could go to the Credit Suisse merger. I mean, wasn't that the big gorilla in the room? Didn't you breathe a sigh of relief when that merger happened? Thanks.
Sure. So, that was really the Swiss government. But we, of course, were following it over the course of the weekend, and we were engaged with their authorities in the way that you would expect, all the ways that you would expect. It seems to have been a positive outcome in the sense that the transaction was agreed to, and it has been the markets have accepted it, and it seems to have gone well. And I think there was a concern that it might not go well. So coming into the middle of this week, yes, I would say that has gone well so far.
Nicole.
Hi, thank you, Chair Powell. Nicole Goodkind with CNN Business. In the summary of economic projections, the FOMC sees the unemployment rate increasing to 4.5% this year. I'm wondering how you anticipate preventing this from snowballing while using the admittedly blunt tools at your disposal.
So that's an estimate of what will happen as demand slows and as conditions soften in the labor market. And it's a highly uncertain estimate. And there's really, we have to bring inflation down to 2%. The costs of bringing it down, there are real costs to bring it down to 2%, but the costs of failing are much higher. And if you read your history, I'm sure you have, you can see that if the central bank doesn't get inflation back in place, make sure that inflation expectations remain anchored, you can have a long series of years where inflation is high and volatile, and it's hard to invest capital. It's hard for an economy to perform well, and we're looking to avoid that, and to get back to where we need to be, back to where we were for a quarter century, and get there as quickly as we can.
The question is, historically, it's hard to.
Mr. Mike, please.
She got in trouble.
That's right. Historically, it's been hard to contain unemployment, and the question is, do you worry about some sort of snowball effect, and how do you factor that into your projections and your thoughts?
Well, it depends on whether so recessions tend to be nonlinear, and so they're very hard to model. The models all work in a kind of linear way. If you have more of this, you get more of that. But when a recession happens, the reactions tend to be nonlinear, and that's so we don't know whether that'll happen this time. We don't know. If so, we don't know how significant it will be. And so, we're very focused on getting inflation down, because we know in the longer run that is the thing that will most benefit the people we serve. That's how we can have we've had very strong labor markets through these long expansions that we've had. 4 of the 5 longest, or 3 of the 4 longest expansions in U.S. history have been really since the high inflation period. And the reason was inflation wasn't forcing the central bank to come in and stop an incipient or an expansion. You can have very, very long expansions without high inflation. And we had several of those, and they're very good for people. You see late in an expansion, you see low unemployment, you see the benefits of wages going to people at the lower end of the wage spectrum. It's just a place that we should try to get back to.
Jean.
The good old days.
Hi, Chair Powell. Jean Young with Market News. I just wanted to ask, with all the events of the past 2 weeks, do you still see a possibility of a soft landing for the U.S. economy?
It's too early to say really whether these events have had much of an effect. It's hard for me to see how they would have helped the possibility, but I guess I would just say it's too early to say whether there really have been changes in that. The question will be how long this period is sustained. The longer it's sustained, then the greater will be the likely declines in or tightening in credit standards, credit availability. So we'll just have to see. I do still think, though, that there's a pathway to that. I think that pathway still exists, and we're certainly trying to find it.
Hi, Chair Powell. Nancy Marshall-Genzer with Marketplace. Just wondering how many financial institutions have been issued matters requiring attention or matters requiring immediate attention citations at this point?
How many? I don't know. But those are serious regulatory, in particular immediate attention. That's and I guess there were 6 of them. So
and getting to the seriousness of it, how are you going to ensure that banks comply with these citations, take them seriously? How will you enforce them?
That is a great question and is right in the heart of what the review will be doing under Vice Chair Barr's leadership. So that
is a great question.
That's what you think about. What can we do to make sure? But again, that's not for me to answer today.
Do you have specific thoughts on that?
Well, I see. If I did, I wouldn't share them because I really this review is going on. And, I want nothing other than us to find out what happened and why, figure out what we can do to do better, and then implement those changes. That's all I want. It's for me to be giving you my half-formed or partially informed
Could it have been
thoughts.
the government spending? No, that's not it, but we don't know.
It just isn't appropriate. There's a real serious review going on with people from all over the Federal Reserve System who are not connected to this work, not connected to this bank. And under again Vice Chair Barr's leadership, and I'm confident that it will produce a satisfactory result.
Okay, we'll go to Jennifer for the last question.
Thank you, Chair Powell. Jennifer Schonberger with Yahoo Finance. Curious, how do you view financial conditions right now? If credit becomes expensive enough, choking off growth, as you said you're watching for, would that situation warrant a rate cut? What situation would warrant a rate cut? And have the bank failures prompted any discussion around changing the implementation of the balance sheet runoff? Thank you.
So we haven't really talked about changing the balance sheet implementation. That's not something we've discussed yet. As I mentioned, we're always willing to change that if we conclude that it's appropriate, but we're really not seeing any signs there. Sorry, then the question before that was, just give me a...
Curious how you view financial conditions now, and if credit were to tighten enough, if that would prompt a rate cut.
So financial conditions seem to have tightened, and probably by more than the traditional indexes say, because the traditional indexes are focused a lot on rates and equities, and they don't necessarily capture lending conditions. So we think that, though. So there are other measures which if they're focused on, bank lending conditions and things like that, they show some more tightening. The question for us, though, is how significant will that be, and how, what will be the extent of it, and what will be the duration of it, and then once you know that. There's a fair amount of research about how that with broad uncertainty bands, how that works its way into the economy over what period of time. And so, so we'll be looking to see the first part of that, like how serious is this, and how does it look like it's going to be sustained? And if it is, it could easily have a significant macroeconomic effect, and we would factor that into our policy decisions. I mentioned with rate cuts, rate cuts are not in our base case, and so that's all I have to say. So, thank you very much.
All right.
What a guy.
What a guy. What a guy. Couple observations. Is that the music? I was like, what is the music playing now? Get the guy's walking out music. This event has now ended. That was not the most confident we've ever seen Jerome Powell answer questions. In fact, that might have been one of his less confident press conferences for sure.
He's flustered.
Notice reviewing the note, him looking down at the notes to answer the question, he did not feel like he was fully prepared for that. Also, there was one question that kind of got into the money printing thing, but they did not was there something that went on and they were told before walking in the room, do not ask about printing money? Because one question was about it and it had to do with the policy with banks and what their policy was with their reserve was, but he did not. He got a nice soft landing day. I'm disappointed in this journalist not just hitting it right on the head and talking about quantitative easing and not printing money. They had some good questions about banks, and I don't think his answers were very good. Here's the real thing though. There's just like this. I haven't even decided how many parts of a wrestling match this is. Jerome Powell is definitely not on team crypto, but he is against Auntie Beth. Auntie Beth believes that interest rates should be cut, and she does not like that Jerome Powell keeps raising rates. But then his also that. His denial that the government has anything to do with inflation is absolutely ludicrous to me. Absolutely stupid. That is the exact reason why we have an inflation problem. And when he goes and says that we spent a lot of money during the pandemic, but now we're not doing it anymore, it's well, what was I asleep? Did I dream about all that money we just sent to Ukraine? I didn't think so. And you don't think that the money we're about to give out to these banks, and just the banks that we know of, there are so many more. Like the one question we're kind of peeking at is a lot of these smaller banks that have these house loans. And when you're tightening this credit and you're making it harder and you're putting pain on individuals and families, well, who owns homes? Individuals and families. Who owns these small businesses? Individuals and families. When you're putting pressure on them, you don't think these smaller banks are going to crumble and fall and die? This was a very lack of confidence and to be honest, we kind of said in the beginning, almost like a marketing ploy. Get out and get a narrative out there. The banks are secure. Do not worry about it. We'll be good. We're going to keep going to tackle inflation. I like that part. I mean, I'm all about, we need to fix inflation. The problem is, as long as you keep denying what the root cause of inflation is, you will never fix it. So while I agree with his thought, hey, we need to get this fixed long term, I agree. But unfortunately, I don't think the answer is interest rates anymore. It's got to be how we spend money as a country. We're going to close out here in just a second, but I want to get your guys' takes. Piper, what are your takeaways from this meeting?
Well, I will say this, that the from wick top to wick bottom was 6% today.
A little more?
Yep, this was the highest volatility that I have seen in months of FOMC. So,
really quick, I wanted to show you guys something on my screen. It's not going to be sharing the right screen. Hold on just a second.
Well, Darren.
Classic too quick to the gun here with what I'm sharing. All right. So I Googled how much money does the FDIC have in reserves? And here's a Barron's statistic. By the end of 2022, the FDIC reported that its fund had a balance of $128 billion, less than half of the $262 billion that might be needed. So that 262 number, who knows where that came from? But surely this number has changed since the end of 2022. But the question is this enough? If small banks were to start to roll over and default based on people not being able to gain liquidity or gain access to credit and starting to default on their mortgages, is $128 billion enough to curb the worst effects of that, of a credit crunch that did start to spread into small banks and even mid-sized banks crumbling, as you said? So that's just something to point out. That's the amount of ammo that they have over at the FDIC. It's limited. It's very limited. That would not put a dent in a major wide-scale credit crunch.
They're hoping for diamond hands.
Yeah.
We hope that half the country has diamond hands. That's all I can say.
Yeah, exactly. Piper, what about you? What are your thoughts?
So you're right. They had to do something. And I think his approach of, the credit, using control methods through credit is going to be how they do it. But then again, I mean, you can't stop the banks from giving out loans, right?
Nope.
That credit credit belongs to the banks. And the only way you can stop the banks from giving out loans is to limit the requirement, the demand for those loans at banks, which is done through rate hikes. So when he says we don't have to continually do rate hikes, we can control it through credit too. Banks can create their own money. They can create their own debt. What you need is better regulation, better oversight, better supervision of the banks. How about that, Jerome Powell? How about you do the other half of your job as the Federal Reserve? So,
yeah. As we close it out, I want to show you guys the Bitcoin chart and something that I'm observing right now. So we broke out to the top, and then it was a fake out. This is what we would call in this ascending triangle a bull trap. We did not make the breakout up closer towards 30,000, which is what we really should have done if that ascending triangle played out. We then came back down, used support temporarily, and now we broke below it. We're coming back down. I'll talk more about this red line. So for right now, I'm going to put these back up later, but for now, I want to get rid of them because I want to show you something on the chart zooming out. And I'm not saying that I'm overwhelmingly bullish right now. I just want to show you guys something for context for anyone who's like, oh, Bitcoin's done. We're going down. Let's go to the 4-hour chart. What was the formation we were just talking about a whole lot here last week? That was that Bitcoin formed a megaphone pattern. All right. Megaphone patterns play out like this. When you come up into it, bullish megaphone, you make your bounces, you break through, you come back down to that former level resistance as support. When you're bearish, you break down, you come back up, former support, turn resistance. What does that look like right there?
That looks like 50x. That looks like 50x, Tim.
Yeah, I'm not saying we're absolutely going bullish, but keep your eyes. When you're looking at TA this evening, keep your eyes there. Again, 6%, we're going to give it the extra 1%. 5% volatility after FOMC, during and after FOMC meetings are not that big of a deal. There, again, that narrative that was put out there, I just want to continue to stress this. Continue to watch them pump the marketing of banks being stable. They're resilient, they're safe, they're good. They're going to keep pumping that up, but the charts don't lie. I saw in chat, by the way, Gia S gave a story. She said her friend, I think she said her friend, went to the bank trying to pull out $10,000. The bank said, I don't have the money. Come back next week. We're going to hear a lot more stories just like that. The BS of the government and the Fed will be called. We are not okay. Banks are not okay. And I still hold fast. Whether we dip back down to 25.2 or not first, we'll see. I still think we're about to see a very, very productive Bitcoin rally, and it could be at the very demise of U.S. banks, especially the smaller ones. Guys, that is all we have for you in this special afternoon episode here for the FOMC meeting. But make sure on your way out, you smash that like button. If you were new here, thank you for joining us. Please consider coming every single morning as we have a morning show from 9 to 10 a.m. Eastern Standard Time, where we talk about Bitcoin, we do the TA, we do the news, we talk about crypto in general, we talk about the stock market, and we really want to help you guys invest better for yourselves so you don't have to rely on these banks and the Fed and the government. Make sure you go ahead and join us every single weekday morning. We'll see you guys tomorrow morning, though. You guys have a great day.